We were talking about the necessity for fixed rules and what constitutes a relatively simple, valid trading plan. We talked about the tradable trend. Without 1 and 2, in my opinion, you have no right to be trading. Actually, you have nothing. If you don't know which direction to trade in, you have no tradable trend. If you have no idea what the support and resistance is, by implication, you don't know where the trade may start to work, and we will cover these points. Entry points, relatively simple. Of all the things, that's the easiest. Exit points is the most difficult. We talked a little bit about multiple contracts, making our life a little bit easier. And as we get into the trading plans and ideas, hopefully you will understand of what I'm trying to explain to you, why it is distinctly disadvantageous to have only one particular contract that's totally finite. Because when you have only one contract, or 100 shares, or 1,000 shares, and it's a be-all and end-all situation, psychologically, when you terminate that position, either at a profit or at a loss or at a break-even, if the market carries on in the same direction that you were trading in, the feeling of frustration immediately arises, and then you say, well, the market is too high now, I don't want to get in and buy, or the market is too low, I don't want to get in and sell. Those decisions of the psychological nature disappear when you have at least 3 options to work with. In other words, if you can divide your trading concepts into 3s, and it doesn't matter if it's a 3-lot, a 9-lot, or a 300-lot, the concepts are identical. Or if it's 300 shares or 30,000 shares, the concepts are identical. You're not called upon to make a finite decision on that particular trade. You can trade around your position, we will talk a little bit more about it because that's quite important. Also, part of the exit point is, which professional traders call stop loss. In other words, you have to have an uncle point where you say enough. This is the uncle point, when psychologically, but hopefully it is a market-generated stop. As we talk about stops or stop losses, I will tell you the certain nonsense that goes on in some bank trading rooms, that the stop losses are not market-generated, but just numbers that the trading room can afford to lose that week, that day, that month. And the inevitable happens. And that's why banks find it just as difficult to make successful trading plans and profits as private traders. The ratio is roughly the same, believe it or not. The ratio is roughly the same, winners and losers, for one of these points which we're going to get to, the concepts that are used in banks for stop losses that are not market-generated stops, and we're going to see in the very next segment we start talking about with the Gann swings, which is the simplest way to explain what I'm talking about. There are much more complicated ways, incorporating 4, 5, 6 different tools. We do not have the time, and quite frankly, it's not necessary. But that's my own private thought, how I approach this particular point. Exit points also cover the ability to stay with the trend in the time frame that you're trading in. If you're trading the daily bars, you must be aware of what the daily trend is in order to stay with your position. Unfortunately, we have 3 different tools that enables us to do that in the Fibonacci Trader program. Some of them are simple, some are a little more complicated, some are visually very elegant, and you will see the results and the value to it. Sometimes, as when we start working on the Gann swings, the simplest tools quite often are actually very nice and reasonably easy to work with. It is human nature, unfortunately, to believe that more complicated equals better. More indicators equals better. Not true. The hardest job I've ever had was to come down from 100 indicators to take a position in the market to 3. It took me 10 years to get up to 100, realize I was wrong, took another 10 years to come down, but I only look at 2 or 3 things and that's it. I guess this is experience, but also the realization that when we see the results of some of the trading plans in relatively tough market like the T-bonds, which is a very sophisticated market, we'll talk a little bit about which markets are easier, what are more sophisticated, that we're trading against some of the best traders in the world. If we can survive and make money in a reasonable manner with reasonable expectations, with simple tools, life becomes a lot nicer. It doesn't mean our brains are happier because of the concept more equals better. Wrong. Less equals better. And it takes a while. It took me many years to find out, but hopefully I can stop you from going down the same mistake roads that I have taken and the wild goose chases, blind alleys, so on and so forth, which are really traps laying for every trader out there. Okay. I want to talk a little bit about, before I get into the other thing, which is we will talk first about GAN basic swing rules, results, etc. I want to talk a little bit about the concepts that I use in order to come up with the ideas that I have so it makes sense to you. One of them is multiple time frame application, which is a fancy word for utilizing different time frames for different results, and how we dovetail these two things, the different time frames together, and why do we do them? Is it easier or better to trade one time frame, or is it easier or better to trade 2 time frames or even 3 time frames together? I don't believe that 3 time frames are necessary. I believe that successful trading can be achieved by utilizing 2 time frames, and we will go into this. And how do we use this intraday or daily, weekly? And this is the interesting thing that some of you who know, who have been working with me, I have some students in the room who has been working with my stuff for 3 or 4 years, will realize that once you get into that frame of mind, it is almost impossible to switch back to a single time frame application. In other words, to make trading decisions just looking at the daily bars if you want to trade the daily, or just looking at the 5-minute bars if you want to trade the 5-minute S&P, whatever your trading goals are. And we will talk a little bit about trading goals, because unless you make a conscious decision what your trading goals are, you can't say to me, hey, I want to be a trader. Big deal. The step number 1 is going to be, what are my trading goals? And this is set up by certain limitation: time, family, money, equipment, real-time data. Can you afford to pay for the real-time data, which today, of course, is reasonable? But you have all the costs involved, not just buying. The computers themselves today are dirt cheap. The real expense starts arising when you start looking at 5 or 6 different exchanges, and every exchange is charging you $50 to $300 a quarter. This is all part of doing business. This is our overheads, and you have to take this in consideration. Okay, why multiple time frames? There are 2 schools of thought, and I don't belong to either of them, as you will see. Maybe that's the reason I make a living. There are 2 schools of thought in our business. Both are academic, and both, I think, are incorrect. Obviously, I would say that. One is that the market is a perfect structure and finds its own balance. I don't want to go into great details, but that is the basic idea, irrespective of what it is, stock market, commodities, currencies, whatever. The second school of thought is that the markets are totally random, and there's no reason, really, for anybody to say anything else, and that the market would just go hither and thither and hither and thither, and no matter what rules, concepts, or ideas you apply, that is their fact of life. In other words, as far as I don't want to go into great technical depth because I don't want to lose you. There are certain concepts with standard deviations, and it becomes a horrendously complicated nightmare of academic explanations why traders really can't make money. And I know quite a few traders who are exactly the opposite. They do make money and have done so for many, many years, and some of them have made terrific amounts of money. Admittedly, it's a small percentage. Like I said, it's about 15%. But these 15%, some names you know, some names you don't know, some are private traders, some are very public figures. But the reality is that there is a whole school of thought out there that says the markets are so random that there is no system, no concept in the world that will work to enable you to make a living. In other words, it's just higgledy-piggledy and goes wherever it likes. My answer is, besides what I said, hey, I've been making a living for a few years, proving you wrong. Because if the market is random, you can't make rules, because you have nothing to base your rules upon if you have a totally random situation. So this argument, and when we come to the reality of what we're trying to achieve here, is as follows. If you have 3 time frames, and I'll try and keep it as simple as I can. Let us say you're trading the 60 minutes, just as an example, and it doesn't matter if it's 60 minutes IBM or 60-minute S&P or 60-minute bonds. This will be the actual time period that you're trading. This is what the time period that you base your trading decisions upon. And as we get, bear with me, be patient, and it will come very clear. And I will explain to you and show you why each time period is an independent active force on its own, and yet it is part of the next time period and of the greater time period. Those of you who are a little bit au fait or have an understanding of the chaos theory, Mandelbrot concepts of fractals, etc., will know exactly what I'm talking about. This is not a very big, complicated process, and you don't need huge mathematical knowledge to understand it. I will show you some pictures and charts when I get into details of how this actually works. But for the moment, even if you don't understand me, just bear with me. So 60 minutes we will call our own time period, and that's the time period we're trading. 60-minute bars. The next time period up from that is the daily. So if you have 5 hours trading of whatever you're trading, so you would have 300 minutes during the trading day. So we would have only 5 60-minute bars. And those 5 60-minute bars make up one day's trading. Each bar is separate, but if you see the situation, let us say this is 1, 2, 3, 4, 5. So this is hour number 1, hour number 2, hour number 3, hour number 4, hour number 5. We don't at this stage even care where the bars opened, but let's say the trading day, and that's a signal, opens there, and the trading day closes over there. Okay? Now, so this will be hour number 1, 2, 3, 4, 5. So if you now take, this was the high of the day, this was the low of the day, and this was the close of the day. If you drew these as a daily bar without you being interested what was the market gyrations during that trading day, what you're going to get is, if that's the high, that's the low. So the opening was there, and the close was roughly there. I can't stand directly in front of it because of the shadows. So this is now the daily bar. So when you're looking at it in the newspaper or on the screen, real time or end of day, most of you who are trading stocks, I'm sure, will be using end of day concepts because you've got other jobs, you're working, you're experimenting, whatever. All you're going to see is this. But what really happened during that trading day, the market didn't go up here, went up a little bit, went straight down and closed there. No. You can see the market undulated during the trading day. And this is how the floor makes their money. But I don't want to go into this. All you have to be aware of is that this is equal to this. That's it. It's that simple. Now, you repeat exactly the same process. If this is 1 day's trading, the next time period that we can look at is the weekly. And 1 week's trading is made up of 5 of these. So if I covered this up and shifted this over and pretended it was the daily, then you say, hey, that's 1 week's trading. And you would see this would be now not a daily bar, but that becomes a weekly bar. I don't have enough space, but I'm sure you understand the concept. This is very simple, straightforward stuff. So we, in Fibonacci trading terms, talk about multiple time frame applications. And this is how it is defined, that the time period that you're actually trading is always called the own time period. The period just above us is the next time period. And the weekly we call the high time period. For our own trading purposes, we almost ignore, it's there, but we don't use it in a normal way, and I will show you how. The only points of real interest to us is own time period and the next time period. These are the only periods that we're interested in order to keep it simple. Trading can be as simple, as complicated as you want to make it. I'm trying my very best in order to keep the concept simple and to try and stop you from going down false paths that will only complicate your life and in the end cause you losses. I've been there, I've done that. I'm trying to stop you from going down the same self-destructive path. What does this mean in the context that we are talking about? How does this go to the process of randomness that people say the market actually works in? What in fact happens is this, that if we have our own time period, which is say the 60 minutes, and then we have the next time period, which is the daily, and then we have the highest time period, which is the weekly. And I maintain, and for the purposes of this argument, you can ask questions, of course, at your leisure or during lunch. I'm available to talk about it. Each of these units are stand-alone units. In other words, each area has its own geometry, i.e., the 60 minutes, if you look at 60-minute charts with nothing else, and we will be working with a computer later on, what you're going to find is that the 60-minute has its own trends, its own moving averages, and any other important points appertaining to it that we can look at. But let us just for the moment talk about trend, as we were talking, support, and resistance. Each of these time periods has its own trend and its own support and resistance points. And of course, it's correct because we saw it here that if this is the 60-minute bar, this is the trend in a very simple way. If you want to connect highs to define a down-moving trend, that's what tells you that the trend of the 60 minutes is down. I don't want to get into great depths about trend and contra-trend at the moment. I'm just trying to get a concept to you why this thing works. And I sincerely believe that every trading concept has to have, to satisfy my ego and my logic, a simple philosophical base. I know that you're not here to learn philosophy, but for me to make this it works for me because it has a simple philosophical base that can be logically checked out. This is why it works for me. Okay, so now we go to the daily, and let us say that the daily trend, these are daily bars, is also more or less down. And let us say the weekly is also more or less down. This is a simple concept which I'm trying to show you. And you only have to look. This does not, if you look at hourly bars, daily bars, and weekly bars on the same commodity or the same shares, and we will see plenty of examples coming up, this doesn't happen too often. Majority of the time what you will find is that the 60 minutes trend may be down, the daily trend may be up, and the weekly trend may be going sideways. In other words, you're getting different pieces of information. Apropos, we just talk about the trend for the moment, from the 3 different time periods. Now, the same thing can happen if you're trading stocks and shares. If I said to you, your own period is not the 60 minutes, but this is the daily. And the next period is the weekly, and the highest time period is the monthly. Identical concepts apply, and also, as you will see, identical mathematical calculations. Fibonacci ratios stay the same. We change nothing, irrespective of what time period, and that's the reason why the concepts work. Because if you change the mathematical calculation, the whole thing is nonsense. Back to the situation here. What we are talking about, why multiple time frames work, and we are talking about the randomness of the market as proposed by certain academic circles. What I have found is that I would say 75% of the time, approximately, and it varies from market to market, commodity to commodity, the markets are random. In other words, guys are buying, it goes up, the markets are selling, the market goes down, so on and so forth. And each of these time frames varies according to who are the main players in that specific market. If the floor traders are selling who are the closest to the market, and I don't care if it's the New York Stock Exchange or the Chicago Board of Trade, the 60-minute bars will start going down. But if the bigger players, hedge fund managers, so on and so forth, are buying IBM, no matter what happens on the floor with the 60-minute bars, eventually the 60 minutes will have to come into tandem in the same direction as the daily. So if the daily is being bought by fund managers, eventually that will follow. But this is not the important point. What we're trying to find is what are the optimum, and this is the way I look at it. Quite frankly, I don't care what the academics say about randomness or non-randomness. I think it's nonsense. But I do agree that the different time frames, 75% of the time, are in apparent randomness to each other. One is going this way, one is going that way. There appears to be total chaos in the market. But every now and then, and that to me is 25% of the time, approximately, all three time frames, be it the 60 minutes, the daily, weekly, or the daily, weekly, and monthly, all face in the same direction. In other words, the trend of own period is the time frame you're trading. The next time period, which we will come to, what is the job of this next time period, and the highest time frame is all pointing in the same direction. I.e., in this case, the trend is down. But let's keep the definition simple. We will have other definitions. All we have to say is if we have lower highs, forget about the closes, we have lower highs and lower highs on all three time frames that we're looking at, non-randomness has appeared in the market. In other words, the randomness that was appertaining when they were going higgledy-piggledy to each other suddenly disappear for a limited period of time, which means that the hourly trend is down, the daily trend is down, and the weekly trend is down. If you can identify those areas of non-randomness, life becomes a breeze, and trading becomes easy. Because no matter what time frame you are trading, there is no randomness in the market. For limited spans of time, all three time frames are in sync as far as the trend is concerned. And if you trade at those specific moments, you will find that your trading suddenly takes off by leaps and bounds, even if you were a losing trader previously. So one of the things that I have to try and get across to you is the importance of this point. This sounds very theoretical, I agree. But believe me, in practice, if you can tune in half the time this occurs, you're going to make money in the markets. Because what happens? Can we control this? No. But we have to be aware, when can this possibly occur? And the market tells us. I always say the same thing. The market is like a big elephant. It leaves footprints in the sand. But it's up to us to be able to decipher or read the footprints. And one of the way the market tells us, if we're using the correct tools, when is the occurrence of non-randomness. And that's where our rules kick in, and trend-following guys make a fortune, and you can pyramid, and so on and so forth. This is very, very important. Theoretically, it sounds like nonsense. Practically, you will see. And you will know when suddenly you put on a trade that is right, the 60 minutes will make money. The day will make money. The weekly will make money. Surprise, surprise, non-randomness has, and that's when your rules really kick in. The rules really kick in when the markets are not random. If I can survive during this period, I'm a happy camper. And I'll lose a few bucks, I'll make a few bucks, great. But I know that if I have a valid methodology, I must make money when non-randomness kicks in. Otherwise, my trading plan is rubbish. Literally. It's nonsense. This is what true trading is all about. There are people out there, of course, who say, hey, I can trade the daily bars and I don't need any assistance from anything else. Fine, good luck to you. I can't. I've tried it. And I have found that by coordinating the time periods as one unit, I am aware of three things. One, I'm aware of the tradable trend, and I will show you how we define it. Two, I'm aware of this true support and resistance. And number three, which is the most important, and it takes the longer inexperience to get to this stage, is when does non-randomness kick in? And of course, when non-randomness kicks in, what do? You increase your size, you're more comfortable in pyramiding, you're not so quick to take your profits, you give the market a little more room to breathe if you have the tools to do that. This is a very important point of successful trading. Some people are aware of it. Majority of the people are not. And that's fine. You know what I mean? I'm not here to preach a religion. I'm just trying to show you the tools that I have become comfortable with, and they worked for me in the past. Whether they will work for you, I hopefully say yes. And I will show you the tools, but this is where I'm coming from. Now, yes? Question?
If the idea is to trade during the 25% of the time when everything is in sync.
I didn't say that. I said if I survive, because the reality is, if you know a way that you can trade only on this 25% area, you have the Holy Grail and you don't sit in my class. I can show you the direction when this kicks in, but I do not know when it will kick in. This is the job of mechanical trading plans. It's a very good question. The question eventually lands up, and this comes up again and again, hey, why bother to trade in this 75% area when this is the area that you make all your money? And it's a good question. And my answer is, with mechanical trading plans, you do not know a day or a week or a month or even 20 minutes before, well, 20 minutes, yes, when this situation arises. So I have to be trading during this period to be able to take advantage of that period. But what is crucial is that you are there trading when this occurs. Because if you're not, you've missed it. You've missed it. And unfortunately, life is not a simple game that says, hey, the fourth week of every month, because it's 25% of the month, is going to be the good week. You don't know. You can have periods, and this happens. I'm taking a 12-month period. It doesn't mean that you have fixed 3 months in the year that comes up to this expectation and performance. But unfortunately, in order to get this, you've got to go through the pain of this. But of course, there are tremendous psychological advantages that if you have a valid, and this is why I said a valid mechanical trading plan. This is where I come from. That majority of the time, and there are people in this room who trade some of my methodologies, that when there is a gap up, and the 60 minutes daily and the weekly all click in, I'd say 70% of the time we are there. We are facing the right direction from the day before. But if we did not partake in the 75%, we would never catch those 25%ers. Never. This is, I mean, if I had this, I would have the Holy Grail. And I tell you, I don't have the Holy Grail. Yes, sir?
Would you consider it non-random if only the own and next period?
Yes, yes. It's also, would I consider it non-random if it's own and next? The answer is yes. Because the next point we're going to get to, and then I'm going to get immediately onto the GAN stuff, otherwise we're going to fall behind, is that when we are actually trading, we are only utilizing 2 time frames. If we talk about intraday trading, it would be, say, example, the 60 minutes with the daily, or you can use daily, even though it can be real-time trading. Both can be real-time trading. I mean, this can only be real-time trading. You cannot attempt to trade the 60 minutes and the daily if you don't have real-time data. That's suicidal, by the way. But if you want to trade the daily with the weekly, i.e. stock shares, or I have plans, bond plans that work on the daily, weekly basis, then I'm only interested in the daily, weekly, either real time or end of day. Both work. It doesn't matter. The rules are slightly different, but the concepts are identical. So let us look at the situation, what is the next step down the road? The next step down the road is to take the maximum benefit that we need is exactly what I said, that the trend is the number one concept for us. 95% of trading plans out there of any kind consider, let's say you're trading the daily bars. The trend is normally defined the daily on the daily. In other words, you look at the daily trend with the daily bars, daily moving averages, daily whatever, daily support, daily resistance, and on and on and on. My concepts are no. My concepts are multiple time frame application, which means that we look at the next time period. This is our own. And this is the period we're trading. This is we're actually trading the daily bars. We make our decision to buy and sell via the daily bars. The weekly, and this is where I part company from the rest of the world, is that I utilize the weekly to define the tradable trend, TR, and the support and resistance, both. And this is where I part company with other traders. And this is the strength of the Fibonacci trader, that it does use the higher time period, which is the next time period up. And that's why your question was a good one, that what we're going to find is that even though the program, when you set up the plan, the trading plans, hourly, daily, weekly, really we're only interested in the own time period, which is the hourly, and the daily is the one that sets up support and resistance. And if you're trading the daily bars, then it's the weekly that sets up the true trend and resistance as far as trading is concerned. I'm only concerned about the tradable trend. I'm not here to prove any theories to anybody, that this is better theory than that. It's of no consequence to me. All I know is that far as I'm concerned, for me this works. When I was trading a single time frame on its own, I had problems. Simple as that. So therefore, the whole program and my rules and backtrack and everything else works towards the end result has to be, for me, multiple time frames. I just hope it doesn't become a buzzword like candlesticks became a buzzword and then it buzzed off. You know, it was the hottest thing since sliced bread, and for whatever the reason, it never was truly grasped by the community. Yes, some people still use it to this day, but it was like the Holy Grail has suddenly arrived from the Far East, but there was something lacking, whatever. So I hope this doesn't happen to this multiple time frame concept. So this is the only thing that we really have to worry about. The trend is always defined by the next time period up. So if you're trading the daily, that's the bars we're trading. The trend and the support and resistance is defined by the next time period up. The only, for true successful trading, this is the way I conceive it. The first work done on this basis was done by W.D. Gann, where he started looking many, many moons ago. I'm talking in Western methodology. He started looking at weekly bars compared to daily bars, and this was passed on from generation to generation. Unfortunately, a lot of his work was misunderstood. Part of it was his own fault, I think. Also, everybody did their own interpretation of his work. Does it mean the pure Gann stuff is better than the interpretations? No. It just means how you use it. All we're looking for here is workable trading tools. We're not looking for who is right or who is wrong, were his detractors, was he a lousy trader, was he a great trader, did he make millions, lose millions? Who cares? Nobody cares. Not really. Only thing we try and do is to walk away from these 2 days with something that works. It happens to be the man, Gann, who helped towards this. Great. I'm eternally grateful to him. No discussion. Okay. We are going to talk a little bit about the Gann swing charts, and we're going to eventually lead into the multiple time frames, then to the computer, so on and so forth. I would like to answer the first question first. This is in your first book, the Gann swing zone book. Excuse me, not the zone book, just the Gann stuff. Let me just get one of these, and I can tell you, I think, where it is. On roughly in the middle of the book, there is the first green page, and it's immediately after the first, excuse me, it's the second green page. Second green page. It ends at about page 390, and then the page after that has no page number. It's roughly in the middle of the book, and it's headed 1997 US T-bonds, New Gann Swing Chartist, Basic Trading Plan. We can't get much more basic than this. This uses, believe it or not, only 2 perimeters. And the pages, those of you who bought my book, and that's why I'm talking about it. Those who haven't, the rules are here, so you don't even have to buy the book if you don't feel like it. That's fine, I don't mind. Question came up, there was a multi-year backtrack on the T-bonds utilizing this basic concept, and I told you in the beginning that I had a number of queries, questions, and one of them was, that was great. We had 5 years on the bond plan, basic, end of day plan, up to 96. Did it survive 97 when the market has been a little bit nuts? How did it do? The results are here in front of you. We started with a beginning equity of 30,000, ending equity 48, blah, 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 largest winning trade, largest consecutive drawdown. I don't have real time to go into every single number here. What it means is that no matter what your equity was, by the way, I would just want to say a couple of things. There are only 2 important numbers on this page. The least important number is the one that's usually advertised in every magazine and every newspaper in the world. The number of winners, number of winning trades. We're not interested in that. There's only 2 important numbers in trading. How many dollars you made compared to the dollars you lost? What is the point of having 60% winners or 70% winners if your winners are bigger than your losers? Fine. But majority of the time when you have such high percentages on a daily program basis, if you have 75% winners but your losers are bigger than your winners, you have a problem. Also, your profitability can be eaten up by commission, so on and so forth. So the important number is, number 1 is look at what is the largest consecutive drawdown. Now, the way this is measured is the accepted standard that's governed by, not by me, but this is the way it should be done according to the future industry. And this is all government official bodies, and this is the calculation, that no matter what was the amount of money at that time in the account, because we start off on January 1 with $30,000. If during March, April, you suddenly ran that up to $40,000, it would be from that point that you would measure the maximum consecutive drawdown. Is that clear? In other words, no matter how much money is in the account, whenever that drawdown occurred, that is the maximum percentage-wise you would have lost of your trading capital. So if you lost it straight out the box, it would be 13.80, say 14% of your 30,000 equity. But if you had 40,000 by June or 50,000 by June in the account, then it would be 14% of the 50,000. This is the maximum you can lose. So this is the way it's measured. So that's number one.
Robert,
Yes?
if you lost it straight out of the chute, it'd be 25%.
No, money-wise, yes, but not percentage-wise.
No.
This is the maximum.
$7,500 out of 30,000 is 25%.
Yeah, but you wouldn't. Let me get into this. I know what you're saying, but you're getting ahead of the crowd. It is from the point of view when it occurred. This is the way the industry measures it. Otherwise, everybody would have a different measure.
If your first trade were the two losers, then it would be 25%. So it depends on when it happens, what the percentage is.
Depends on the money, actually. We'll talk about this in a moment.
Robert,
Yes.
what's the difference between those results and the results on page 40? They're different, but the heading is the same.
Page 40.
Oh, one's 87 and one's 97.
Ah, thank you. It's only 10 years apart. Okay, we'll forget about that. Okay, the next important point you should look at here is not the winning trades or the losing trades. Percentage profitable, 58%. That's not bad. I'm quite happy with that. If I have 50-50 according to the way the plans work, I'm happy. Return on account. Now, the return on account, this is 63%. Now, the reality here is this is before commission. You must deduct what you like. Some people pay outrageous commissions, in my opinion. Some people trade with discount brokers. The way we trade, you don't need to pay $40 commission or 35. There are 100 brokers, good discount brokers, who will be happy to oblige you at $20 to $23 range. Some go down to 17. Whatever you can get is fine. Okay. The next important number is the profit to drawdown ratio. Percentage-wise is 2.49, and I'm reasonably comfortable and happy with that. Okay, now what we can do, if those of you who want to, you can see that the same, what I call this no-brainer plan, if you go in the same section, go to the back of it, it says 92 to 97. That means whenever it terminated, I think last Friday we brought it up, return on account was 399%, okay? This does not mean we made 399% per annum. What it means that every January we start always with $30,000, okay? No pyramiding. This is the basic plan. There's no pyramiding. So if you started with the 30 grand, in the end, without trading any more contracts, you're only trading the initial lot that the program trades, okay? You would have landed up with 400, and it looks great, but it's nonsense. And this is, I put in there just to show you how easy it is to tell the public one story that's not reality. Would you trade for 6 years, not making one mistake? Would you trade for 6 years without going on vacation? Would you sometimes not say, hey, I need 15,000 for my house renovation, and I'm going to draw it out the account? Of course. But this is not an accumulative. In other words, this is done on the first initial investment. So this is like a machine if you trade it like a machine. So therefore, this is of no interest. So this really just nonsense. But it is the actual number of 9.91. Anybody who knows anything about profit drawdown ratios will realize what it's all about. Okay, that was just for by and by. But the important thing here is to learn a little bit about our basic plan. If I went into the professional plan, of course, that's got a far superior return for 1997, but that's another story. Okay. Please take this to your heart. Now, whether Albert Einstein actually said simplicity is the voice of God in my trading room, I only have two pictures on the wall as far as people are concerned. It's Albert Einstein and Pythagoras. Obviously, that tells you a little bit where I'm coming from. Whether he actually said this, I do not know. He's reputed to have said this. So that's why I used it, that simplicity is often the voice of God. And this particular plan is as about simple as I can make anything that has a chance of working in the market. There's no guarantee from me that this will do as well next week, next year, next month as he has done in the past. I cannot give you this guarantee. All I can tell you that for the 10-year backtest that I've done on it, it's done okay. Not fantastic, no 1,000% per annum returns, which some people are look for, which is dreamland, of course, but it makes a living. That's all I can say. It makes a living. Okay. Right. All I would like to do in this particular session is to go through some of the simple definitions of what constitutes swing trading, because I know that this is a reasonable basis for starting out, especially for people who are new to trading. But those of you who are professional traders, when you combine the swings of the two different time periods, very interesting things begin to happen. And you can actually work it in, and I'll show you how, and dovetail it in with your own ideas for trading, etc. Those of you who this is old hat to you, please be patient. Okay. An upswing can only occur when you have two consecutive higher highs. In other words, the trend has been down, we've been going down, and we want to define what constitutes an upswing, and we're looking at only one thing. I should move it down, that would help. Swing direction. And to see it visually, this is what it looks like, swing direction, that prices have been coming down. That's the low of the move, and suddenly we have an upswing. This is in chart number 1. But what is the definition here, and it is very different from previous Gann definitions. I don't want to go into the whole story behind it, but two consecutive higher highs. In other words, it needs, if you said, well, this high is higher than this high, yes, but that's not good enough to define a change of swing direction. It's got to be two consecutive, and the word is consecutive, higher highs. So number 2 must be higher than number 1. Just if you didn't have this first bar here, if that bar disappeared, then you would only have one consecutive higher high than the previous one. You need 2 for the swing direction to change. Of course, exactly the same applies to the chart below. And the swing direction, you need 2 consecutive lower lows, 1 and 2, in order to make this a genuine downswing as far as our definition is concerned. Okay. So the swing direction, this is number 1. The next point is trend definition on one time period basis only. We're going to get back to the tradable trend business in a moment. This is strictly talking about Gann swing charting as the way he portrayed it and the way it's portrayed in the book and in the program, and then we will tie the two concepts together of the higher time periods with the Gann swings, as you're going to see. Okay, with the trend, we only ask two questions. What causes the trend to change, and how does the trend go into neutral? At the moment, I will only talk about change of trend, and the neutral part we'll come back to in a moment. I don't want to confuse the issue. And number 3 is support and resistance. The definition of support and resistance. How does support hold or fail? And how does resistance hold or fail? Okay? So those are the only two things that we're going to work with at the moment. What we're going to show here is an uptrend changing downtrend changing to an uptrend. Because, of course, I'm not printing all these charts in color, on the computer program, on the Fibonacci trader, the dashed lines are in red and the solid line is green. The implications are obvious. Okay. In order for prices to change to an uptrend, this can only happen when the prices take out a previous peak. A peak is defined where you have a peak of the Gann swings at this point that I'm showing. So in order for prices to change to an uptrend, a previous peak, the most immediate peak before us, has to change to an uptrend. When this is taken out, the trend changes. Going to a downtrend, and the trend's been up, and we can see the trend's been up because the Gann swing line is solid. Remember, solid equals uptrend, dashed line equals downtrend. With the once we have the computer up, of course, we can see green and red, it's easy. So the previous valley is taken out. When the moment the previous valley is taken out, which is the low point of the V here, the trend changes to a downtrend. Remember, we're only looking at the daily on the daily. Simple situation. And the definition is clearly stated in the book that you have. On page 14 there it tells you in a downtrend.
Then it only needs to move one and not two consecutive.
No, this has nothing to do with the swing itself. The swing direction will only change if you have two consecutive higher highs or two consecutive lower lows. Okay? That's what causes the swing direction to change. That's a different story from the trend. The only thing we're interested in now with the trend definition is that the previous valley has to be taken out. Now, if you look at this, let me show you a small example. Here we have, in this downtrend, it changes from an uptrend to a downtrend. Okay? Now, you can see that the trend is, these are illustrations only. When you see on the computer, we will go bar by bar, and you will see exactly what happens. The important point here is that when this valley point is taken out, it changes to a downtrend. And that's what the rule tells you, that in the book, they're exactly opposite each other. So if it changes to a downtrend, the trend changes from up to down. Prices must take out the nearest valley, and the trend was previously up. In other words, the trend had to be up to change, otherwise it can't change. Downtrend is shown as a dashed line. The definition of trend change is the same for any time period being analyzed. Now that's quite important. No matter what definitions we use for trend change or for support or resistance, the definition stays constant for every time period. In other words, don't change it just because the hourly bars are being looked at or the daily bars are looked at. Because you don't know if these are daily bars, hourly bars, or weekly bars. It doesn't matter. The trend definition is the same. So that is the second point. How does the trend change? So the only thing we're concerned with was upswing or downswing, which can only change 2 consecutive higher highs or lower lows. And the operative word is consecutive. The second thing that we're talking about is the trend changing from uptrend to downtrend, downtrend to uptrend. And there's only one way it can change on this methodology. There is no other way. You don't have to learn a million different things. And believe it or not, this is the last definition. We only have 3. Upslope, then we'll talk about the slope, but this is not part of the problem. Support and resistance, this is the third point. Support is defined by the valley, irrespective of trend. Don't confuse the two things. Because here you can see the line is solid, therefore it's in an uptrend. Even though we are congesting, you can see the market's going sideways. Because the line is solid, the trend is up. No previous valley has been taken out in order to cause a downtrend. So this is the support point, this previous valley here, and it tells you this is support. If this price point here would have penetrated below the support, guess what? The trend would have changed to downtrend. So in other words, what we are saying in a very simple way is that in order for a trend to change, the prices have to take out a previous peak or a previous valley. Without it, it cannot happen. But by being able to define that as we start actual trading concepts, this is a very handy tool. Because what are we actually talking about here? I don't even know if I should go into great depth about this, but I better mention this. What actually causes these peaks and these valleys? When the prices are rising, I'm going to keep it simple before anybody makes any sort of comments on it. I know they're equal and they're equidistant apart, etc., etc. Okay. When this price, let's say that we're in an uptrend, and this is also in an uptrend, until we take out the previous valley over there. So prices have to take out this price point in order for this to become a dashed line. And what happens, this becomes a dashed line the moment this point is taken out. Okay? What is happening here? This is just an independent line? Of course not. These, I call them MVPs, maximum vibration points. Again, call them pivot points, swing highs, swing lows, isolated lows,